Federal Reserve, I would say the dovishness is going to stay on the table, and if anything, they will just say that they're keeping an eye on the economy to see if it's accelerating at too high of a rate. Now, what you can see here is with the Euro US dollar is that it is trading above the 112 area. It's trading at this point, the 112.35 pivot is our initial support directional pivot. Now, in between that and the 112.90 pivot, we have a critical breakout zone. Now, this range area is probably where the market is going to be trapped in for another, I would say, week or so. Now, if we can get a close above the 112.90 pivot, and that would take out the downward sloping resistance for the current bear trend as well as confirm strength. Now, does that mean that it's going to be a very bullish move that's going to unfold? Not necessarily. What it probably means is that you're going to see newer move highs with higher move lows, but this range is very tight. Over the past few months, you've basically been in a $2.50 range for the Euro US dollar. Typically, you wouldn't have this kind of range with this type of news and activity that's going on in the marketplace. So, that being said, to see an overheated rally that's going to take this market back up to 115, 116, 118, 120 area, which would typically happen in the past when you bounce off the 111 area and have no reasons that would pound the euro any further to the downside. But because of the dovishness globally with the central banks, the carry trade is probably off the table, which would not fuel a Euro US dollar over-exacerbated bullish move. So currently right now, I would say the 114.20 swing high upside target would be pretty much what you can look for over the next week and a half to 2 weeks. That would be probably how it would unfold if this would be able to gain bullish momentum. Like I said, settling above the 112.90 pivot is huge, and then there's also crossing the 113.25 pivot. Once it's above there, you're at the upper part of the trading range that the market's been stuck in for the past few months. That, not necessarily bullish, but it is definitely stronger for the euro currency. In lieu of Brexit and other things that are going on in the European environment, there's no real economic fundamental reason for the euro to gain very much strength against the dollar right now. So that's why I think that this 114.20 swing high upside target is at least the first stop where you'll probably see a turn back towards support. And that would be the area to challenge. Now, any aggressive move above 114.20, especially a close above 114.20 in the next couple of weeks, would definitely be a move that any euro US dollar trader would want to be concerned about, because in that sense of where the outlook would change is that even if the bullish spikes don't hold, you should see higher lows and at least see an elevation of the range trade, which may put the area where it's at right now, this 112.35 to 112.90 area, that would become a total support band. It wouldn't become a breakout area anymore for the upside. It would have become an area where you may see some downward spikes, but most likely you'll see a lot of buying that comes into there. The one thing that seems to be very common in the short run with this little critical breakout area is that the market can slam through it to the downside, but it doesn't seem to be able to follow through below it. The most recent move low was definitely a new lower move low, and right now we have yet to see if it's going to be a lower move high from the current trend over the past 4 days. So on just a technical, basic outlook, lower move highs, lower move lows, this market is in a short-term bear trend. Obviously, that's that just points out and jumps right out at you. What you need to really be considered about is that, like I said, this critical range, because when it dips down there, it bobbles, it gains very little bit of volatility in one way, but it does gain support because buying seems to hold it in. The selling pressure dies. And when you look at the volumes on some of the moves, they don't justify the overzealous selling or buying. So we have some vacuum moves, and when you have thin liquidity, especially in an environment that is liquid as the currency markets, and especially one of the major currency crosses such as the euro US dollar, you have to wonder where the true support and supply and demand functions are. And that's why I said, like right now, don't get overzealous about any type of breakout in this area to the upside, because it's just putting the market back into this range. It's not necessarily bullish. It's not necessarily bearish. And we're heading into summertime, and with the news that we have going on, if Venezuela turns around and they seem to start to have a little bit more of a positive lean towards the Brexit future, then I would say that this range-bound area is going to hold as far as a support basis, and then you'll probably see further spikes higher. Now, what I would take a look at is, if you notice the green trending line from the one low that goes up to the swing upside target, that is our projected median line for now. So if you are to get any type of bullish move, you should probably see it spiking up into that line, and any closes or trending above that line, that would be where we have a definitely positive bullish signal. Now, when you look at the weekly and monthly signals, especially the monthly, because we just turned from April into May, there's no real major reason to say that the euro is turning against the dollar, but there's also no reason to say that the euro is faltering against the dollar either. As much as weakness may be seen in this currency cross, the reality is that it doesn't hold below 112. It was a surprise to see the spike low last week, where it touched down below 111.5, which has been the real support level for a while, but it still couldn't get below 111 even. So it definitely had a nice sell-off, but the bears definitely lost their footing, and all of a sudden the bulls pulled it back into the neutral range. So what I would do is, like I said, watch for the critical closes. Any close above 112.90 or especially 113.25, you're looking towards heading towards that green median line, which means a shift in trend. That would make last week's low a key low to focus on as far as risk for any long-term long positions. And for sure, any turn of events that takes out that low would mean, obviously, once again, lower move lows, lower move highs, which is definitely a bear trend. So right now what we're looking to do is see how we can, whether this rally sustains itself, gets those positive closes, but if it doesn't, and now you have to remember that even though we have radical moves in the currencies, nothing happens all in a day. So we could come in back into this critical breakout area, chop around, and then we can have a corrective break. See, right now, the short-term view would be that this rally going on is a corrective rally. It is not a bullish indication for this market. So let's see how this moves in over the next few days. If it turns back on support and just doesn't go much below 111.5 or holds that area, then I would see that this is just then any downside move. So that in that situation would be a dip to buy, and use that as a new basing area for another rally that would take out whether today's is the new current short-term high of this move, or if it's extended into the next couple of days. We have to see what happens. So that's really where I would say you should look for the euro US dollar, is to look for a buying dip scenario if you're not already long. And if you're long, I would definitely, because it's Fed day, use tight stops. I mean, you know the risk. Right now, the good thing is that your risk level is not as extreme as it usually is. The euro has been trading in a range between basically 114.5 and 111.5 for predominantly most of the year. I mean, it was up at the 115 level in January, but then it's been trending. Obviously, there's where your trend. It continued the trend lower, making this situation right now look like a corrective rally. But in lieu of certain economic factors, and now the way the central banks have turned on their outlooks, especially because back then, the central banks around the world weren't necessarily dovish. Now everyone's on the dove plan. So that being said, like I said earlier in this video, that the carry trade is probably off the table. So look for the technicals right now. The fundamentals right now are very, very mixed. The problem with that is that a lot of what fundamental numbers people are looking for, everything is being looked at on, they're downplaying it. So any expectations in Europe, they're being overcritical of things slowing down and being bad. And what happens, the numbers, just like here, now not as extreme, are not as bad in Europe as they say. There are woes over there in different parts of their of the EU. The Italian issues, Spain is still a weighing issue. I would say that the Italian bond rating issue action that happened last week is a good thing. It's a very good thing. It's supporting, keeping their bonds from being junk bonds. That would be something that, if that continues, though, to the negative as far as ratings going into the third and fourth quarters, then obviously that would weigh on the euro and the euro-US dollar cross. But the BBB rating is definitely a good thing that came out, as well as their banking system. There are some new stress tests and other issues that they are maintaining to look at to make sure that they can support any type of financial crisis. So in those regards, they're very solid. But they do have a problem with their debt ratings with some of the EU countries. And if that downtrend continues,